Hi guys, welcome to a new video here, Sublime Traders. I'm Logical Orange, and in this video we are going to talk about hedging. So hedging is a very important strategy that we can use in our trading. It is a strategy that sounds almost too good to be true, because its purpose is to make us gain in both directions. This is the best scenario, and if used with other strategies, it can increase profitability and maximize profits, reduce losses to the smallest amount possible. So without further ado, let's get going.
We gon' make sure you never miss a trade again. Watch how you get paid over and over again.
So before we get started on hedging, I just wanted to show you how you can take profit with RENKO and HA candles, because hedging is the most effective strategy when used in conjunction with these types of candles. Because, well, HA and RENKO candles are not influenced by time, but they are influenced by price, so they are price sensitive. So basically, when you enter a trade with RENKO or HA candles, you need to follow only the color changes in the candles. So if, let's say, you want to trade a breakout signal right here, let's say you would enter here, and exit on the candle that changes color. The same thing goes here. You would enter here, you would exit when the RENKO candle changes color. This is an exit in profit. But what happens when the trade goes against you? So let's say you entered here because you saw there is a breakout. You entered here, but the price goes the other way. Well, right here, what you need to do is to DCA your way in so that you lower your entry. What I mean by this is that when you enter the first trade, you will not enter the whole your whole account. This is logical. I tell you guys all the time that you do not you are not supposed to enter all in. This is stupid, and you should always have some kind of buffering backup that allows you to DCA your position to a lower entry price. So let's come back to the example. You have entered your first trade right here. The market goes against you. You see another another RENKO candle that turns. That can tell you that it is a good opportunity to rebuy, and you rebuy at around this level. This is your second entry, and the price continues to go down. Well, right here you have another entry. So you have 3 entries until now. With these entries, if they are in if you have the same amount of positions, you will get an average entry at about this level right here. I will just show it on a different color. So let me just change the color. So this would be your average entry. So right now, the difference between your average entry and any take profit you can see. So the first, remember, as I told you, the first candle that changes color in the trend, so this would be right here. This difference is called TRY, or trade recovery interval. This is what we use to make profit when we DCA our way in on this type of trade. So with this out of the way, let's move on to hedging. So for hedging, we need 2 things. We need 2 trades basically. We need the initial trade, which is right here, which is a short, and we need a backup position, which in this case is a long. For the initial trade, I have chosen to take profit at around this area, which coincides with the mean value of this formation right here, and the stop loss is around here. For my backup trade, I have chosen to place my stop loss just above the entry price of the initial trade, and the take profit is equal symmetrically with the initial trade. So now that we have our trades placed, needless to say that they are of the same amount, we need to see what the possible scenarios are. And we have three scenarios. The first scenario is that the trade will go in the initial direction. So we were right on the first one. The price will go all the way down to take profit. We take profit, we close a hedge, and we move on. The second scenario is that the price would go a bit down in our direction, and then it would hit the stop loss of the initial trade and move all the way up to the take profit of the second backup trade. The third scenario, which is not a good scenario, is that the price will go a bit in our direction, will go to stop loss, will possibly just go a bit in the backup trade direction, and then move back to stop loss. So in order to avoid this type of behavior, we need to remember that this strategy is only usable in important breakout zones where we have important support and resistance levels. If there are also news coming out, we need to be careful and we need to plan accordingly. This strategy can be used regardless of the time zone, but as long as the market is moving. So this is the most basic approach for hedging. Let's move on to some more advanced techniques. So guys, I'm very excited to share this with you. Now that we have seen the basic hedging strategy, let's move on to a more complex hedging strategy that uses no stop loss. So what we have here on the chart right now is called a sequence. It's basically a chain of trades that go in both directions for as long as any take profit isn't hit. So let's take this example. Everything you see here are trades with no stop losses, and the two lines that you see here in orange are the entries. This is the entry line for the short sequence, and this is the entry line for the long sequence. And the area between the two is called a zone recovery area, and is also the distance to the acceptable stop loss on the original trade. So this would be the stop loss for the original trade. So let's start with the first trade. Let's imagine that if the price goes down, we enter $100 right here. If the price goes down, we take profit here. This is beautiful. It won't happen, or rarely. It usually happens like this. We go down a bit and then it goes up, and then maybe it does something like this. And maybe if we are in luck, we can hit the take profit target on the second trade of the sequence. So this means that we are short $100 and in loss, but we are long $140 and in profit. This profit, the difference between the second trade and the first trade in amount is meant to cover the zone recovery area, so the distance to the acceptable stop loss, and create some profit. In this case, we would be profitable. If the price doesn't reach this area, it might go a bit like this. So it goes down, it goes up into the second trade, and then it decides it wants to go down again. Remember that we usually like to place hedges and use hedging strategies in markets that are kind of moving. So if they are stale, if they are in a range, we might range for this for a long time, so it's not recommended. We need some volatility, but it can be applied on very small time frames and it can be effective. So back to the example, I have exited the second trade and I have come back into the short area where I entered another trade for $100. So right now I am $200 in short and 140 in long. So if the take profit reaches, I have the profit from the 2 trades that I have accumulated, and I have the loss from the long trade that I have placed before, and the 2 shorts compensate for the loss of the first one and gives me some profit. Of course, this sequence can go on, and the differences from one trade to another, from long to short, are meant just to cover the zone recovery area. I will post the exact formulas for calculating in our group and on our cloud. Also, I forgot to mention that once we start the sequence, we do not close any trade until we hit a target take profit. So either it can be on the short side or on the long side. We close everything as soon as we take profit on any given side. So guys, hedging is a very important weapon in a trader's arsenal. If used properly, it can not only prevent you from losses, but it can help you gain in multiple market conditions. I really hope that you understood this video. If you didn't, just leave a comment down below so I can maybe clear things up for you. And if you liked it, please leave a like and subscribe to our channel. And if you want to know more about Sublime traders, don't hesitate to come to our Telegram group. Thank you and happy trading!